Welcome back to the channel. I'm Ozbourne Foreman, and today I'm going to be talking about the market. So at the moment, as you are likely aware, all of the markets, including the S&P 500, the FTSE 100, are all up about 4 to 5% year to date. I understand that we're about 2 weeks in now, and there's been a lot of hype over the Christmas period, mainly because obviously people hadn't had a chance to buy any stocks, and I thought this would be a little bit more short-lived. However, at the moment, as I say, the stocks are up about 4 to 5%, and I do think that this is a concern. I think this is something that we should be wary of and that we shouldn't get too optimistic for the remaining year. Now, I do understand that obviously the markets have had a pretty poor year formally. So like the S&P 500, for instance, last year, it was down about 14 or so percent. So we had obviously some minor shakes going on, but across obviously the world, stocks have been going down due to the overall environment of the economy. Now the stock market is forward thinking, right? And obviously we've had inflation figures in the US that are about 6.5%, which was 7.1%. So obviously there is an element of optimism going on right now, which is leading to stock prices pushing upward. However, I would like to encourage caution. I think we've got to remain disciplined as investors. I don't think anyone at the moment has gone to the extreme of going, right, I'm going to put my life savings into the stock market, or they're going to go, I'm going from cash into equities. But I do think there is something to be keeping an eye on here. This could obviously be the start of obviously a more promising future, and stocks could be rallying for the rest of the year. So I could be wrong here. But what do I gain from being wrong? Well, okay, let's say the worst thing that happens, right? Already I've got a lot of money invested in the stock market. If I hold fire from investing for a month or two, or just hold a little bit more cash than usual, okay, sure, I won't make as much money by investing all of it right now, but at the end of the day, if the stocks do go down, then you've also got an opportunity there where you're able to pick up some good bargains. That said, across the board, stocks are at very attractive levels. There are some obviously American stocks that are trading at very favorable valuations. Some of them are still a little bit too premium with the likes of Amazon, but there's certainly some good discounts in and about. So perhaps now, on the other hand, is a good time to buy in that regard, because obviously the markets are up 4 to 5% already. But if they were already, if in your mind that you considered they were at depressed prices, then now could also be an attractive time. But I think the main thing is that we should not buy into the hype. We've got to be mindful. Great, my portfolio itself is up 14-15% year to date, but truly, has anything fundamentally changed with the business I hold? Has the moat increased? Have my businesses now got more market dominance against their competitors that makes them a much more attractive buying opportunity? Well, truth be told, of course, across the board, all of these stocks have been rallying. So again, it doesn't really necessarily single out any stocks, but it is worth considering. Because if you found an effective valuation for the companies that you hold, and now suddenly these stocks are pushing up to higher prices, there's a point where you go, okay, look, this stock is overextended. There's a little bit too pricey right now, and I don't think this is a good time to buy. And obviously, by doing those valuations and doing the research, you now have the conviction to know whether to buy or hold as it continues to rise. Now, you may even go to the other extreme where you're looking to trim or take profits. And I think we're a little bit too early days here for the overall general market here. And again, I'm a long-term investor, so taking profits isn't really part of the agenda. And I therefore feel that continuing to average into the markets, but leaning to the side of caution, could be an effective strategy to adopt here as we go into this year. Obviously, it does look promising for the year ahead. It does look like inflation is going to be reducing over time, which is a great sign. However, we could take a little bit longer to get this under wraps than anticipated, and I think there's a lot more optimism than there should be in the markets at the moment. And depressed prices obviously are good for investors if you plan to invest for a longer period of time. So now could obviously be that great buying opportunity. So more than ever, it's important to be going, okay, I'm going to remain a bit more disciplined. I'm going to continue averaging into my stocks, but I'm also going to build a valuable cash position. I'm then going to go and identify these stocks and go, what do I think a fair price is for them? Now, I've done this before, and I've said before that I've struggled with pricing and identifying a fair valuation for these stocks. So what can you as an investor do if I've even found finding price targets or creating them quite difficult? Well, I think you've got to look at one metric. What is the most important metric in a business that you think will ultimately bring you, earnings in the future? What will give you a return on your investment? Well, typically it's profits, right? You want to see profits increase over time, and companies that have had profits increase over time have typically generated a lot of shareholder returns. Now, obviously, they're not going to generate the most shareholder returns because there are a lot of speculative stocks that obviously steal the thunder, steal the hype, see extreme rates of growth, and obviously that's where a lot of the returns are, especially when you're buying these very, very micro cap or small cap stocks that have that ability. But identifying, okay, profits, and I prefer free cash flow because profits can be manipulated a lot easier. It's very easy with accounting to write things off, have high levels of depreciation and amortization. You're saying that this asset, that jacket behind me, right, is going to last 20 years, right? Well, I'm writing off a part of that value each year until those 20 years are up, in which I will no longer use it. Well, for all I know, that jacket, whilst it's leather, it's well made, it could be lasting 30 or 40 years. Now, this is unrealistic for a jacket, especially one that's for a motorcycle, so it's very unlikely it will last that long in general. I mean, the leather might, but I don't know if it would be, up to date with modern standards. But again, the idea, the premise is there. Businesses are continually writing things off. They're counting depreciation into their profits. Now, I'm not sure based on IRFS 16, but I also have seen a lot of people saying, oh, look, our property's depreciated here. And I don't know if that impacts profits. But if that's the case, that's mental. But that's unrealized capital gain. So perhaps I'm wrong there. So yeah. Take what I just said on a whim. The idea is you want to be looking at a metric, and I prefer free cash flow because there's less adjustments to it. Now, if we're looking at business and we want to grow, how do we find an effective ratio? Well, the price to earnings growth ratio is what I would consider to be a good ratio to be acquiring businesses for. If a company has higher earnings growth than the likes of their price to earnings ratio, the same can be applied if you substitute earnings with free cash flow, then I think it is an attractive business. One that I've bought recently is the London Stock Exchange Group. Now, they've got a free cash flow growth over the last few years of quite a high number, but that's because of the likes of Refinitiv being acquired. Prior to that, though, they did, I think, grow their earnings by about 15% or so per year, but they'd had very unstable earnings. The point is, based on their free cash flow at the moment, they're trading at about 22 times free cash flow, and I think that's achievable when they optimize Refinitiv going forward, that they're able to get a good chunk on that figure. And that same thing applies here. So once you have identified the metric you want, you can then identify a price. What free cash flow price to earnings growth, is this an attractive thing? Well, 1-to-1 could be a good model. That's what Peter Lynch goes for and what I just explained. Or you might be more greedy and you might go, okay, well, what is the current free cash flow growth? Let's assume Boohoo's free cash flow growth, which it hasn't obviously had because it's currently, I think, negative in cash flow. Let's just say Boohoo's free cash flow growth is 15%. Then I'd be looking for a price to free cash flow of less than 15 times. Okay, so what would that be factored into the price if we account for our free cash flow? And let's just assume it's 2018 levels, which is well before the pandemic benefit, but also before the pandemic losses, and go, okay, we'll multiply by this. And likelihood is it might find that a fair price for Boohoo is 50 pence per share. The point is once you've done that and you know the value of your companies and you've got a good metric in place, you've got your reasons for buying it, it's a very good idea to be writing down why you bought this company, because it's very good for both reviewing in the future, but also coming, as you say, when you come back to it and you can review it. But what I truly mean is it's very good at reaffirming your conviction in the stock. Why did you buy this company? Well, it's a fantastic business because of its ever-growing moat. And you can come back in 2 years' time and go, has the moat been growing? Yes, it has. Great. Now I know I've bought this. My conviction remains the same, and I'm unlikely to sell out on a loss. As I say, the markets are increasing at the moment. It's very important that we remain disciplined. When we look at my portfolio, for instance, my stocks and shares are up 14.4%. So it's quite a big move. And considering at one point in time, about maybe 100 days ago, my portfolio was veering to nearly 60% down overall. We're now down to 45% down. And that's certainly a large improvement from where we were. I'm personally going to be improving my portfolio by adding 1 or 2 more stocks in the near-term future. So it's very likely I'm going to continue building this position with the London Stock Exchange Group, and I'm going to add an American stock, so a US equity is going to be added into the mix that I think adequately diversifies the portfolio. Although I think that this US equity that I will be adding, which I won't mention yet, but if you think you know what it is, definitely leave one in the comment section down below. And what I will be doing is I think in the short term with this US equity that I'm interested in, it's going to have a tougher time. There's going to be, overall macroeconomics here that are likely not going to favor the business. But going forward, I think it's a very fantastic company that will be lasting for some time to come. I should also mention as well, Games Workshop has declared a dividend of £1.30 a share. So dividend income is going to be huge for the next year, considering how many shares of Games Workshop that I currently hold at the minute. Thank you for watching. Have a fantastic weekend.